All right. Hey, good morning, guys. Thanks for dialing in this morning. Always appreciate you dialing in live, and excited to kind of start working through some stuff. So if you've been watching the markets, and I know you all have, it it's been like super boring to watch because we haven't gone anywhere, but at the same time, it's been excruciating because it feels like we've gone everywhere, right? Especially in the corn market. We've had some real volatile days. So let's put some context around that and give you some ideas about where we may be heading next and kind of prepare for this report. So what we're going to do today, I want to look at two charts that we normally don't look at, which is the dollar and oil. Second, I want to look at supply and demand tables and just kind of run some what ifs for next week, and then we'll end by looking at the charts. So as a backdrop, fundamentally, here's what we've got going on. In the grain market specifically, we have um, we have the growing season in South America and the South American harvest. So we've seen, and this is all expected, right? As South America harvests, we see the Chinese and other buyers flood down there to buy their products right off the combine. That makes sense, and that usually puts some pressure on our markets. The problem that we have this year is that um, uh, it hasn't really impacted our uh, our price. We haven't seen the pressure that you might otherwise have seen. But there are a couple of things here that could impact us negatively. So the first is the dollar. As the dollar starts to rally, this is counterintuitive to me for sure. I think it's counterintuitive to most people, but that's okay. The market is telling us something. There is no reason why we're rallying the dollar after printing as many trillions as we've done. And so why are we all of a sudden screaming higher? And overnight here, this high that we reversed from on March 9th got taken out. So we don't want to see the dollar explode up even more. I don't think this is horribly impacting our prices yet, but it's definitely something that we want to watch because we want the dollar down for our prices. And the other market that I want to show you is this oil market. So this is just a continuation chart of oil, dating back to last year when we actually went negative, right? We went to $30 negative in some places. And so now we peaked out at about $68 a barrel, and we've had a couple really bad days in a row. And remember, oil imploding is bad for corn because of ethanol, right? We want high grind margins. We want that price of gasoline up so we can make sure that we're grinding plenty. Now, I think the reason that oil's down, if we're going to try to give an explanation here, is because of the shutdowns in Europe. They're discouraging travel and they're trying to limit what's going on there. And OPEC, just from a policy perspective, the traders have decided that that's possibly bearish. So as we look at oil, we would like to see it stabilize. And for sure, we don't want to see it start to work below its cloud and enter into a downtrend, because I think that can put pressure on our corn prices, which is what we don't want to have happen. So from a fundamental standpoint, the grain fundamentals are really, really good. They are as good as we've had since 2010 and 11. It's a demand-led market. The demand is strong. South America's yields are questionable at best, and the safrinha crop that's just now getting planted is vulnerable because the forecasts are showing that the dry season may come a little bit early down there. So if that crop gets tight, then that should be bullish. So the grain fundamentals are great. These two things that I just showed you are worrisome to me for sure. So it's something that we really want to pay attention to. So let's look at a couple of other markets here before we jump into corn and beans. This is soybean oil, and those of you that know me know that I definitely don't trade soybean oil, and I rarely follow it because we don't like the distractions that can come from it looking at soybeans. But if you look at this thing, it's just been on an absolute tear, right? And there's nothing weak about this chart. It's actually forecasting higher prices. So if we look at and you start to read the news, you're going to hear, oh my gosh, it's topped. We've got a little hook reversal in the that happened yesterday. If we get follow through selling, it's soybean oil Armageddon, and we're going to go much lower. That's not at all what this chart is telling us. If anything, it's telling us we might get a pullback, and that's something that should be bought. But if you look at the fundamentals, and I've been trying to read as many people as I can that are more knowledgeable about bean oil and the oil market, you know, as a whole, the fundamentals there are really bullish, and stocks are coming down, and we need as many oils as we can get from whatever type of source. So I think oil should continue to work higher over time, and there's a lot of people talking about the 2012 highs in oil, which are a little bit higher from here, but those at least being tested, if not challenged. What's stopping us from really exploding higher is the soy meal. Right now, the soy meal is kind of just laying flat down on the mat, and if it were to turn though, and start working higher, then that could be explosive for soybeans. So again, I don't trade soy meal, and I rarely follow it. So this is not a realm of expertise for me at all. But I do know that the relationship between it and beans are very highly correlated, and so if this starts to move higher, beans should work higher as well, and I think that's underpinned in the tilt of these markets. So if you look at soybean oil here, or soybean meal, I'm going to put this trend channel up here. Okay, if we connect these lines together and then pop this one down here, you've got this downward tilt to soy meal, right? So it keeps bouncing kind of inside this channel. If it's able to get up to 415 or so and get up outside this thing, that should ignite a little bit more rally. But if we take that channel, right, and take a picture of it in your mind and look at that downward tilt, you should see soybeans kind of mirror it and reflect it. And that's just not at all what's happened, because we actually have an upward tilt in soybeans, if you see that. So, we're not at contract highs on soybeans, but the tilt of this market is up. And when the main product coming off of beans is tilting opposite, that's going to correct itself eventually. And there's a lot of people that think, well, beans are overvalued and we're going to rip this thing way lower. Well, not with a balance sheet that looks like this. So here is our supply and demand table, right? And we are talking about a balance sheet that has a 2.5% stocks to use number and 120 million bushel carryout. You're not going to take a number like that and push this market significantly lower. If you look at this as this whole move as a correction in beans, you just continue to see it get underpinned by strength. And so if the products start to move with it and shift and break up out of its channel like we talked, then beans could get explosively higher, especially as it's starting to come out in the news that the the ships that are in South America can't get loaded for a whole variety of reasons, but they can't get loaded, and so they're coming to the Gulf, and that's causing our Gulf rates to spike. So you're seeing river basis firm. You're seeing beans become more in demand, and this is the time of year when they should not be. So that underpinning strength is just being reflected in this upward tilt of the soybean market during a correction, and that is a really bullish sign. So we're still really bullish beans. I don't see anything that says that old crop beans are going to implode and work lower. And if you look at the supply and demand tables, you got to get some pretty extreme assumptions here to make a bearish case for beans. All right. So this is the Outlook Forum, and I'm sorry. This is I've been playing around with these numbers a little bit. So this is what the USDA has been saying: 120 million bushel carryout. If we plant 85 million acres, there's a lot of people out there starting to talk about lower numbers, 86, 87, because everybody's going to plant corn. And if we hold demand the same, we go negative. I mean, you've got to make some pretty harsh assumptions here in order to keep this number positive. And if you get into any weather issue at all or increased demand, which is what we've actually been doing, then this number turns negative. So this case really the market can't let that acreage number happen. You've got to push something up into this 90 million acre number in order to get the numbers back to a reasonable level. So if you yield 54, right? We've never even come close to a 54 yield, so that's not going to happen. But let's just pretend that everything's perfect, and let's pretend that we harvest. The weather's so perfect in 2021 that we harvest almost 100% of our acreage at an all-time record yield. And I mean, man, it's just perfect. And let's just assume that we lose 200 million bushels. Those are crazy assumptions that I just made, and our carryout goes back to what it was 1 year ago. If you do anything more reasonable than that, then these numbers just start to come right back down. I'm still at a 50.8 yield, and I'm still harvesting 88 million acres. You'd start to drop this number to a reasonable number, right? And have a normal discount. Pretty soon you're back down into this under 100 million bushel number. So there's no margin for error on soybeans to lose acreage, because if we look at our corn demand table, you've got the same scenario. So here's what the Outlook Forum said. This carryout it had back in February. Here is what the USDA has been telling us in March. Now, what we know for a fact is that ethanol grind is picking up, and we know that China continues to buy. Last week they bought another 150 million bushels. So as those numbers creep up, the USDA's got to reconcile that by raising this number. And so corn, 92 million acres may not be enough. We may need 94 just to maintain this level right in here on the corn piece. And if you raise 95 and you harvest 88 and you cut and you pick 180 bushel corn, and you don't increase demand, then yeah, we're bearish, right? I mean you can make an argument that this should happen, but it's not a good argument, right? That it's way too early to say that something like that is going to transpire. This is a lot more likely that we actually increase demand 400 to 500 million bushels, that we yield something more in line with an average rather than an all-time record, and that we plant a reasonable amount because of the soybean story, right? If the world needs all the oils and we need all those acres, then beans are going to have to go crazy. And so we were doing some homework yesterday, and we were talking about what this corn bean spread needs to be in order to talk you into switching to acreage that you need to have. And I won't go through all the math that we had, but we're trading a 261 number, and historically that's been a number that would swing the profit margin from corn to beans, right? That's a number that would typically do it. But as we start to put in fertilizer prices and land rent prices, that number doesn't swing this the acreage, the profit margin the way we thought it would. We need this spread to widen out to 3 or better in order to generate the acres that it looks like we may need. Because we've got to get from 89, we've got to get from 76 last year to 90. We've got to get from 83, what they said in March, to 90. We need to pick up 7 to 9 million acres of corn, of soybeans. And this ratio, mathematically, when you do the math and you assume that you're using, Illinois and Iowa economics, it just doesn't really work. So, I think this thing's going to resolve itself higher. I think beans are going to pull apart, and the catalyst for that will be next week. So as we look at like December corn and say, hey, should we hedge? Should we not? Where do we want to be? Well, if you just look at what these numbers are going to do, and you just think about the reality of the situation, right? December corn crop insurance levels are right here. We're a dime above them. Into a plantings report where weather and acres have never been more important, and we think corn's just going to puke it up. I really don't buy that argument for a minute. And if we're dead wrong, we're going to get chances to get lots of coverage on in this 450 area pretty quickly. I mean, the market's not going to just crash and stay down there, right? We're going to get lots of shots. So I think the risk reward, I think the best and most prudent advice for coming into this report is to be patient. 460, 470 December corn in relation to everywhere else that we are. I can go to May corn. May corn's gone nowhere, but the spread between May and July is out to 18, 19 cents a bushel. That's as wide a spread as you're gonna get. I mean, it's insanely bullish. So the market is calling all of the product into it's calling it out of the hands of who's storing it now. It needs it. It's desperate for the product. So this little sideways trading range seems boring, but a lot has actually happened. So this should resolve itself to the upside as well. And I don't know if that's going to be because beans are just so bullish or because meal's going to happen. These sideways markets are excruciating because it feels every dime drop or every nickel drop feels like it feels like you're just having your heart ripped out. But the reality is we're closing at the highest levels we've closed in years, and the fundamentals just continue to get more bullish. And so we'll see if those can hold and outweigh the fundamentals coming from the dollar and oil. If those kind of correct itself, then I think watch out, because we're sitting on a recipe here that can be radically explosive to the upside when you just add the whole thing up. So I think patience. I think it's okay to be optimistic that we're able to see some higher prices because of what's going on in the rest of the world. And if we get bad news next week, then we'll change our mind and we'll adjust based on what we have. But I don't think that jumping in and spending a ton of capital on puts for 470 corn is prudent given the overall situation that we're in. And I think wheat and everything else follows. I think wheat for sure follows corn and beans. So we're not even going to get into talking about wheat necessarily, because I think it's trying to ration corn for us, and And I think it's going to be too little, too late. It's actually just going to hurt itself as it puts itself into the feed ration. All right, that is 20 minutes, and as always, we promise to keep it at 20 minutes. I could talk about this all day long and go through, so many different scenarios, but low volume, tight trading ranges always precede explosive moves. So our bet and our view is that move's going to be to the upside given the whole situation. And if we're dead wrong, then we'll know it probably by next Wednesday, and we'll change our mind. So we fully understand that can happen, but I think the weight of the evidence is telling us we gotta just hold for where we are right now. As always, there's significant risk in trading futures and options. If you are trading, make sure you're trading to the level of your own financial ability, and talk to a professional before you put positions on. I hope you guys have a great week. We will talk to you soon.